Hello, everyone, and thank you for listening to our presentation. Our group consists of Sarah, Kelsey, Evan, Tariq, and myself, Giordano. Our project is on considering an investment for Apple to manufacture batteries for electric vehicles in North America. On today's agenda, we have the following: context, project objectives, cash flow assumptions, cash flow estimates for our two scenarios, and the analysis and comments, with references to follow. First, for context of our project, society is slowly shifting towards renewable energies in response to global warming and natural resource depletion. Also, Apple has current investments in lithium-ion battery technology for the development of their cell phones. They also currently have a team already allocated for the research and development of car batteries. As per the Biden administration, the current goal is to have every vehicle manufactured in the United States be powered by electric batteries by the year 2030. They currently only account for 2% of the on-road vehicles in the United States. In terms of our project objectives, the first is to create a new factory that can produce electric car batteries that are sold to OEMs. Our analysis will include a single factory's construction, the ramp up, and full production of electric car batteries. The number of factories can be multiplied based on the future demand for electric vehicle batteries.
There are two main sources of funds required to initiate the project. Initially, we came across the ATVM loan, and that is the Advanced Technology Vehicles Manufacturing Loan Program, offered by the government at an interest rate of 1.13%. We chose this loan as we met the eligibility requirements in accordance with our project's scope, under the umbrella of electric vehicles and alternative fueling infrastructure manufacturing. The loan amount will be $3 billion. In addition, $1 billion to be contributed by Apple directly into the project in year one as well, making the total funds received $4 billion. The funds will directly feed into two major investment buckets, which are the construction of the factory building for $2.3 billion and all equipment, robots, and tools for $1.7 billion, with the capacity to handle the volumes we are anticipating on producing. For depreciation, we decided to break it out into two major components. The first is the factory building, and second is equipment and tools. We considered the straight line method approach to show consistent expenses across the 15 years for both categories. In terms of the factory building, on the CRA website, we figured it belongs to Class 1 CCA or Capital Cost Allowance Rate, meaning we can consider 4% annual depreciation. However, it also notes that if a building is used in Canada to manufacture or process goods for sale, then there's an additional allowance for 6%, making it a total of 10% CCA rate for the depreciation of the building. In terms of the tools and equipment, we figured they belong to Class 43 CCA rate of 30% annual depreciation eligibility. Please note, according to the CRA, you're required to consider only half of the CCA rate on the year of purchase, meaning in year one, we have accounted for only half of the depreciation expenses on the financial statements.
In order to complete the financial statements, including the income statement, balance sheet, and cash flow statement calculations, a few assumptions were made. For ease of calculation, it was assumed that the funds from Apple and ATVM loan are to be dispersed at one point in time rather than over the 15-year period. We assumed that the Apple battery factory would produce a maximum capacity of 35 gigawatt hours per year. We also assumed that the prior tax year losses will not be adjusted against future taxable profits for the net income, and that the interest on the loan would be paid the following year. We decided to analyze two different scenarios for this project. The first was to assume that the cost to manufacture an electrical vehicle battery will be reduced from $120 per kilowatt hour to $50 per kilowatt hour by 2030 due to cost savings in the bill of materials and the cost of production and equipment. This assumption was made based on projections provided through our research. For our second scenario, we assumed that the cost would be reduced from $120 to $80 per kilowatt hour by 2030 due to a limited reduction in cost savings. This scenario is assuming that there could still be some challenges in the industry for reducing the prices for production.
After identifying our two scenarios, the next step was to create our financial statements, with the first being the income statement. In order to form the income statement, we needed to assume a production value for the facility's future. Following the example of the Tesla Gigafactory, it was assumed that the first 3 years of the project would be spent designing and constructing the facility. There would be a year where the facility performed at half capacity for testing and debugging of equipment and machinery. In year 4, it is assumed that the facilities will run at full capacity, at which time the demand within the electric car market will far exceed the expected capacity of 35 gigawatt hours per year for the facility. The revenues in each scenario were based on a 30% markup on the cost of goods sold to the end OEM. This number was based on research of LG Chem's current business model. The cost of goods sold was assumed to follow a linear decline year over year based on the research progressions, with the year 2030 reaching a value of 50 kilowatt hours in scenario number 1 and 80 kilowatt hours in scenario number 2. Scenario number 1 was calculated on average a 12% year over year return on investment, with scenario number 2 having a 12% year over year return on investment. Both scenarios did result in a positive net income once the facility started production up to the end at year 15.
Here you can see the balance sheet for both scenarios. Our current assets are listed as the inventory, which includes raw material, work in progress, finished good, and service parts. These values were built based on data analyzed in Tesla's past inventory levels and applied to our scenarios. Cash and cash equivalents from the cash flow statement are also listed as current assets. The non-current assets are identified as property, plant, and equipment, and depreciation, which Tarek spoke about earlier. The current liability is the interest paid on the borrowed funds, and the non-current liabilities are the ATBM loan liability. The shareholders' equity is listed as Apple's investment and retained earnings.
The pro forma cash flow statement is used to calculate how much cash flow there is. This is based on operating cash flows from the project, cash flows from investment, and cash flows from financing. To calculate the operating cash flows from the project, it uses the total of net income, the increase-decrease in cash working capital, depreciation, and interest expense. The cash flows from investment is the amount of property, plant, and equipment from the current year minus the previous year. The cash flow from financing is calculated by the long-term liability loan payable. This also shows the opening cash balance and then the closing cash carried to the balance sheet. The cash flow from investment and financing is the same for both scenarios. The cash flow from investment is negative $4,000 million in year 1, since this is the year that the investment takes place. The cash flow from financing is a positive $4,000 million in year 0, since this is the year that the money is financed, then it's 0 from year 1 to year 15. Scenario 1, for the price per kilowatt hour, drops to $50. The operating cash flows from this project starts out at 0 in year 0. In year 1 and year 2, the operating cash flows from this project is a negative value. From year 3 to year 8, it becomes a positive operating cash flow, which means that Apple Inc. starts to make money from the electric batteries. Year 9 and year 15, the value of the operating cash flow becomes a constant positive value of $252 million. For scenario 2, the price per kilowatt hour drops to $80. The operating cash flows from the project is 0 in year 1 and negative from year 1 and 2, and then positive from year 3 to 8, and then it has a positive $501 million from year 9 to year 15. The main difference between scenario 1 and scenario 2 is that the operating cash flow values differ. The constant value after year 9 is a good comparison, and in scenario 1 is $252 million, and in scenario 2 is $501 million. This is double the value from scenario 1 to 2. This means that the cash flow of scenario 2 is a lot higher. It's almost doubled than what it would get in scenario 1. The cash flow statement for NPV determination. This shows the recurring project cash flows, interest paid, and release of loan assets. The weighted average capital cost is the same for both scenarios. It takes into consideration the debt and equity components. The weighted average capital cost that has been calculated for both of these scenarios comes out to be 8.11%.
For this project, it was assumed that there were no international cash flows. As of 2017, over 94% of Apple's cash was allocated overseas, which made the government loan an enticing option at a low interest rate. In terms of our project capital structure, the research that took place ended up shaping our results. The main costs were the initial construction costs and the ongoing manufacturing costs, which were both found within an in-depth analysis of Tesla's Nevada Gigafactory.
Project objectives should be achieved to deem the project a success. This means that the facility is built and reached its maximum capacity within our allocated budget and timeline. This project has substantial opportunity for growth, with the option to build additional factories if successful and future demand expectations are met. The return on invested capital was estimated to show high profitability, and this will help Apple diversify their portfolio. So now we have the final question. Would Apple accept this project? Based off our analysis and the assumptions we used, yes, they should accept this project. The internal rate of return was calculated for both scenarios based on the expected finances during the first 15 years after the initial investment. The internal rate of return in both scenarios was noticeably higher than Apple's current weighted average cost of capital. This means that taking on this investment is a profitable venture for Apple. It will also help get their foot in the door of the electric vehicle industry.